Imagine for a second that you're trying to put a precise, like a numerical price tag on one of the most stressful geopolitical questions of the decade.
Right, which is, it's almost impossible to do.
Yeah, exactly.
Yeah.
I mean, we're constantly hearing about it in the news. People are arguing about it online.
Yeah.
But what if you had to boil all that anxiety down to a single percentage point?
Just one number.
Just one number. The question is, will China invade Taiwan? And today we are doing a deep dive into this really fascinating market analysis from June 2026.
Yeah, it's titled Betting on the Strait.
Right. And our mission today for you listening isn't to debate politics.
Definitely not.
Yeah. We certainly aren't taking a stance on international relations here. Our goal is just to explore how, high-stakes prediction markets, specifically leveraged traders, are stripping away all that emotional noise and just mathematically quantifying the risk of global conflict.
Which is super interesting when you look at how they do it.
It really is. So, okay, let's unpack this, because the core numbers right now, as of June 2026, are frankly pretty staggering if you only follow mainstream headlines.
Oh, absolutely.
On Polymarket, which is this major prediction market platform, the yes outcome, meaning an invasion of Taiwan happens before the end of 2026, is currently priced at just 6.45%.
Which is incredibly low.
Right. So the no outcome is sitting at this massive 93.55% consensus.
Yeah.
The market is essentially saying, with near certainty, that an invasion is just not happening this year.
Yeah, but the raw numbers are striking, but the most vital piece of data isn't actually that current 6.45% figure.
Really? What is it then?
It's the trajectory that got us there. I mean, markets are dynamic engines of information, right? That this contract didn't just, magically appear at 6%.
Right, it had to move there.
Exactly. Over the last 6 months, we've seen an absolute collapse in those odds. And understanding that downward trajectory is really the key to understanding how global intelligence is being digested and processed by the financial sector.
Because traders aren't just pulling these odds out of thin air.
No, not at all.
So before we can really understand why the market feels so incredibly safe right now, we need to understand the financial mechanics of, what just happened over the past 6 months?
Yeah, because this hasn't been a calm, flat line.
No, not even close. Let's look back to late 2025. That yes contract was trading at 30%. And today, like we said, it's at 6.45%.
That is a huge move.
It's a 23-point plunge.
Right, which represents one of the largest sustained moves in the history of geopolitical prediction markets.
Wow.
Yeah, to put that in perspective, in a binary market, meaning, a market where an event either definitively happens or it doesn't.
It resolves at 0 or 100%.
Exactly. A 23-point drop in that kind of market is seismic. It indicates a fundamental rewiring of how the market actually perceives reality.
So let's talk about the math of leverage here, because the mechanics explain how these traders actually operate and why they care so much about a 23-point move.
Let's do it.
If you look at that 6.45% yes price, there's a massive asymmetry there.
Right.
If you bought yes at roughly 6.5 cents and a resolution actually happened, meaning an invasion occurred, and the contract hit 100%.
Which is the worst case scenario globally.
Right. But financially, that would deliver roughly a 1,450% return. And that's just unleveraged.
Yeah, and that's where it gets crazy, because platforms like Predmart.com, they allow traders to use up to 5x leverage.
Wait, explain what that means for the listener.
So it means you're borrowing capital from the platform to artificially amplify the size of your position. So that 1,450% unleveraged return, that suddenly scales to over 7,000%.
Oh, wow. Over 7,000.
Yeah. You're putting down a small amount of your own capital, but controlling this massive position in the market.
So it's this astronomical potential payout. But then you look at the other side of the trade, right? This ends. No contracts sitting up at 93.55%.
Exactly.
If you're holding that to the end of the year, the upside is basically capped. I mean, it can only appreciate another 6.5 points to hit 100.
Which is, what, about a 6.9% unleveraged return?
Right, or roughly 35% if you're maxing out that 5x leverage. So holding that leveraged, no position is basically like buying a slow-growing government bond, but it comes with an earthquake clause attached to it.
I love that analogy, an earthquake clause.
Yeah, because you have this steady, high-conviction grind upward. It feels incredibly safe month over month. But if the unthinkable happens, if the earthquake hits...
You don't just lose a little bit of money.
Exactly.
Yeah.
Because of the leverage, you lose absolutely everything.
Right, and that earthquake clause fundamentally shifts the psychology of the trader. What's fascinating here is how margin trading fills the gap between, simply having access to a market and the ability to capture exponential returns on probability moves.
How so?
Well, let's define what shorting actually means in this context. Shorting is essentially betting against an outcome.
Okay.
Think about the trader who shorted the yes contract back when it was at 30%. By riding that massive drop down to 6.45%, they avoided a 78% loss on a long position.
Wow.
Or, conversely, they captured a 43% gain on the no side.
Right, but leverage introduces severe danger there, doesn't it?
Oh, absolutely. If you're leveraged 5x and the market moves against you by just 20%, your broker will issue a margin call and automatically liquidate your position.
So you're wiped out instantly.
Instantly. Therefore, the traders driving this price down to 6.45%, they must have absolute ironclad conviction. They are risking total liquidation just to chase a 35% yield.
And that ironclad conviction requires catalyst, right? I mean, a 23-point collapse doesn't happen just because thousands of traders suddenly experienced like a collective feeling of inner peace.
Right, they aren't just meditating their way to these numbers.
Exactly. They're reacting to a very specific shift in the intelligence landscape. So let's look at the real-world data that caused these highly exposed leveraged traders to completely abandon the yes position.
The first major domino to fall was the March 2026 ODNI report.
The Office of the Director of National Intelligence.
Right. They released a formal assessment that explicitly downgraded the 2027 invasion timeline. And, this wasn't buried in a footnote somewhere. It was a core conclusion.
What did they actually conclude?
They assessed that Beijing views an amphibious invasion as incredibly high risk, and that the leadership vastly prefers coercion over actual kinetic warfare.
Okay, but I have to push back here a little bit.
Sure.
For you listening, you might be wondering, are traders putting too much blind faith in a single U.S. intelligence report? I mean, isn't it dangerous to trust one government document when the stakes are literally global war? Or is the media just chronically overhyping the threat compared to the actual military reality on the ground?
It's a vital question. And it really speaks to how prediction markets process information differently than the general public does.
How so?
Well, prediction markets heavily weight intelligence reports from entities like the ODNI because those reports represent an aggregation of classified information that retail traders simply cannot see.
Oh, interesting. Like what?
We're talking about satellite imagery, human intelligence assets, deep signals, intercepts, things that are completely behind closed doors.
So it's not just one guy's opinion.
Exactly. When the formal U.S. intelligence apparatus shifts its public posture from "we are highly concerned about a near-term invasion" to explicit skepticism, the market interprets that as the tip of a massive classified iceberg.
Okay, that makes sense. So the market assumes the ODNI sees a logistical reality that makes an invasion impossible in the short term.
Right.
And that leads directly into the next major data point, which is the May 14th to 15th Trump-Xi summit in Beijing.
Yeah, this was huge.
And again, for you listening, I want to reiterate, we are looking at this purely impartially as market data. We are evaluating how financial markets reacted to an event. We're not endorsing the political figures involved.
Right, we're just looking at the facts of the trade.
Exactly. And factually, that summit ended with a mutual preference for the status quo.
Yeah, the specific content of that summit is really what drove the market reaction. I mean, the two leaders discussed artificial intelligence regulations, global trade tariffs, Iranian sanctions.
Rare earth minerals supply chains.
Right. But Taiwan conspicuously produced no major breakthroughs, and more importantly, no major breakdowns.
This is kind of a nothing burger on Taiwan.
Exactly. In the high-stakes world of geopolitical risk, a deeply boring summit is a highly bullish signal for peace.
Because if an invasion were imminent,
you'd expect severe diplomatic fracturing, right? Not routine trade, talks about rare earths.
Right. And the final piece of this reality check, which honestly seems like the most obvious one when you think about the sheer physics of warfare, is the total lack of mobilization.
The physical reality on the ground.
Yeah. To invade an island across 100 miles of rough ocean, you need ships. You need hundreds of thousands of troops. You need to commandeer civilian roll-off ferries. You need blood banks.
All the logistics of war.
And none of that is happening. Even the Chinese military drills in December 2025 the Justice Mission drills, they were heavily scrutinized. But the market correctly interpreted those as coercive signaling, not actual invasion prep.
Because you simply cannot hide an amphibious invasion force in the modern era. The intelligence footprint is just too massive.
Satellites see everything.
Right. We live in an age of persistent, high-resolution commercial satellite coverage. If the People's Liberation Army were massing the logistics required to cross the strait, every trader with an internet connection would see the supply depots expanding months in advance.
So it's not a secret you can keep.
No, not at all. The combination of the ODNI's explicit skepticism, the boring diplomatic summit, and the visible absence of physical troop movements creates a highly credible, extremely robust, no environment.
Add to that the visible U.S. deterrence, too.
Yeah.
I mean, the analysis specifically points to the ongoing negotiations for a $14 billion U.S. weapons package for Taiwan.
Which is a massive deterrent.
Right. The market is calculating that Beijing recognizes this physical deterrence.
Oh.
Okay, so a full-scale D-Day-style amphibious invasion is effectively off the table for 2026. The odds are at 6.45%.
Right.
But does that mean that Taiwan Strait is perfectly safe? Because anyone who watches the news knows things are still incredibly tense in the water and in the air.
And that is a crucial distinction to make. Just because there's no full-scale invasion doesn't mean there is peace.
Right.
The Taiwan Strait remains one of the most heavily militarized zones on Earth, and the market is absolutely not blind to the risk of accidents.
And here's where it gets really interesting. The analysis dives into the nuanced alternative contracts that traders are actually using to hedge their bets.
Yeah, let's look at the timelines first.
Okay, so the yes contract for an invasion by June 30th, which at the time of this writing is just days away, is at a microscopic 0.4%.
It's essentially a dead contract.
Completely dead.
Yeah.
But the yes for an invasion by the end of 2027 is sitting at 8%. So it captures the residual uncertainty of a longer, like 18-month timeline where policy shifts could actually change the landscape.
Right, because the further out you project, the more the fog of war obscures the outcome. But the most revealing data point actually isn't the invasion contract at all.
No, it's the military clash contract. The contract asking if there will be a China-Taiwan military clash before 2027 is currently trading at 12%.
If we connect this to the bigger picture, it really reveals how sophisticated these leveraged traders actually are. Structurally, the market is pricing a clash at 12%, which is nearly twice the probability of a full invasion at 6.45%.
Right.
This creates what traders call a spread opportunity.
To me, looking at this clash versus invasion spread is exactly like looking at sports betting.
Oh, how so?
Well, going long on a clash is like betting that a hockey game will be incredibly violent and have a ton of penalty minutes.
Okay, I see that.
But shorting the invasion is like betting that despite all that violence, the players aren't going to actually burn the arena down and the game will still finish.
That is a great way to put it.
Right. Like, you're much more likely to see a fight than you are to see the arena destroyed, and the market is pricing in that exact disparity. Let's walk through a hypothetical $100 trade so the listener can see the actual mechanics of how a trader profits from this.
Sure, let's do the math. So a trader identifies that gray zone coercion, which involves, military aircraft repeatedly crossing the median line, ships aggressively bumping into each other.
High-stakes posturing, basically.
Exactly. They see that carries a high inherent risk of an accidental kinetic incident, like a pilot makes a fatal error or a ship captain miscalculates a turn.
Which happens.
It does. The trader wants to bet that this accident will happen, so they take $50 and go long on the clash contract. And going long simply means buying the contract with the expectation that the probability and therefore the price will go up.
But they also know an accident doesn't necessarily mean World War III.
Precisely. So they take their remaining $50 and short the invasion contract.
Ah, hedging it.
Right. They're betting that even if a missile is accidentally fired, diplomacy will prevail and it won't escalate to total war.
Okay, so what happens if there's an incident?
If a minor clash happens, their long position on the clash contract spikes to 100%, paying out handsomely. Meanwhile, because the event didn't escalate to a full invasion, their short position on the invasion contract remains completely safe.
Wow. So the payout from the clash covers any minor fluctuations, and they profit from the friction without having to predict a global catastrophe.
It isolates the probability of a mistake from the probability of a deliberate total war.
But wait, If the no contract on the full invasion is such a slow, incremental grind upward, how are these leverage traders actually making their money month to month?
That's the big question.
Yeah, I mean, if nothing happens, that 93.55% just slowly creeps toward 100. That sounds incredibly boring for someone using 5x leverage. Where is the actual action?
The action is entirely driven by volatility. To understand where traders extract value, you have to look beyond the static numbers and examine the specific timeline of upcoming geopolitical events.
Right. And if you look at the calendar for the back half of 2026, it is basically a roadmap for geopolitical anxiety.
Oh, completely.
It isn't just a random list of events. It's an escalating narrative of tension. It starts in August with the Kuang 42 live-fire military exercises in Taiwan. But there is a huge twist this year that changes the baseline for everything that follows.
Yes.
For the first time, these exercises feature U.S.-style military intelligence integration.
And that integration fundamentally alters the calculus for Beijing. Historically, the People's Liberation Army always responds to these annual Taiwan defense exercises with their own demonstrations of force.
A tit for tat.
Right. But Taiwan successfully testing new, deeply integrated U.S.-style intelligence networks crosses a subtle red line.
So what does the market expect?
The market fully expects the PLA counter-exercises to be unusually aggressive in response. This is a prime moment where the yes odds could artificially spike from 6% up to 10 or 12% purely on the optics of the military drills.
Okay, so this creates a powder keg of tension in the region. And that powder keg gets even more volatile because right after those drills conclude, September brings the scheduled delivery of F-16 Block 70 aircraft and MQ-9B Sea Guardian drones to Taiwan.
Timing is everything.
Right. Weapons deliveries always cause diplomatic friction, but coming immediately off the heels of aggressive military drills, it sets the stage for a massive escalation in rhetoric.
Which brings us to the match that actually lights the powder keg. Following the drills and the weapons deliveries, October 1st is the PRC National Day, marking the 77th anniversary.
And what happens then?
This event features a major address by Xi Jinping. According to the market analysis, this single speech carries the highest catalyst risk for instant market repricing of the entire year.
Wow. So just a single phrase in that speech about reunification timelines, especially given the tension from August and September, that could send the markets into an absolute frenzy.
Absolutely. And this raises an important question about capital efficiency and discipline. Remember the danger of margin calls we discussed earlier?
Yeah, total liquidation.
Right. If you're a trader operating with 5x leverage, you are heavily exposed to tail risk.
Tail risk being?
Tail risk means that tiny 1 in a million chance of an absolute catastrophe, or in this case, the risk that Xi Jinping says something wildly unexpected that causes a massive instantaneous spike in the yes contract.
Oh, I see.
So a smart trader is going to dramatically shrink their leverage positions right before October 1st to avoid being wiped out by a single sentence.
Or, conversely, they might deploy leverage specifically into the August Kuang exercises, fully expecting the yes odds to spike because of the military posturing, just so they can short it at the pop and profit from the inevitable reversal back to the no consensus once the drills end?
Exactly. They're surfing the waves of anxiety.
And the waves don't stop after October.
Right.
Because the very next month, on November 28th, Taiwan holds major local elections for mayors, county magistrates, and councils.
Yeah, local municipal officials do not dictate cross-strait military policy or national defense, obviously. However, the intelligence community expectation is that these elections will trigger massive cognitive warfare from Beijing.
Meaning disinformation.
Yeah. Cognitive warfare means massive disinformation campaigns, deepfakes, cyber harassment, algorithmic manipulation, all designed to destabilize the Taiwanese electorate. It creates a chaotic information environment, which, again, generates volatility that traders can exploit.
And then finishing out the year, in Q4, we see some delays in physical deterrence. The AGM-154C missile deliveries to Taiwan are pushed back to 2027 or 2028.
Though 18 HIMARS systems are still on track to be delivered.
Right. And finally, December 31st brings the final resolution of the 2026 contract, which historically coincides with Xi's New Year address.
When you view these events sequentially, the integrated drills, the drone deliveries, the National Day speech, the cognitive warfare of the elections, you really see how a leveraged trader constructs a timeline of volatility.
The psychology here is just fascinating to me. These traders aren't looking at an F-16 delivery or a fiery political speech and genuinely expecting them to trigger a global war.
No, not at all.
They are looking at them as lottery ticket dynamics. They know the general public, fueled by mainstream news, will likely overreact to the October 1st speech. And that predictable public panic allows the leverage trader to buy low and sell high.
They're trading the public's anxiety, not the actual probability of a war.
Exactly.
The math strips away the rhetoric.
It really does.
Yeah.
So, to bring this all together for you listening, geopolitical headlines, by their very design, are meant to grab your attention, which almost always means making you feel anxious or panicked. But when you look at the financial markets driven by cold, hard cash, the terrifying threat of margin calls, and extreme leverage, they paint a drastically different picture. Despite the military drills, despite the speeches, despite the weapons deliveries, the people who have to back up their opinions with their life savings are pricing in a 93.5% probability of stability for the rest of 2026.
It's an incredible lesson in information hygiene. Watching where deeply incentivized people actually put their money is almost always a vastly better gauge of underlying reality than watching a 24-hour news broadcast.
100%.
We started this deep dive by asking you to imagine putting a precise price tag on the stress of a global conflict. It turns out, when you force people to actually pay that price, the panic evaporates and the mathematics of probability tell a much calmer, much more rational story.
But consider this one final lingering thought to mull over before we go.
Oh, yeah.
If prediction markets have become this highly accurate at aggregating classified intel, and if the global community is increasingly watching these odds to gauge true geopolitical risk.
At what point do global superpowers realize they can game the system?
Exactly. Imagine a state actor covertly deploying massive amounts of their own capital into Polymarket or Predmart, intentionally driving up the yes contract on their own invasion odds, just to project false deterrence and confuse the intelligence agencies of their enemies.
Weaponizing the prediction market itself to create a phantom threat.
Right. That is a terrifying, brilliant, and completely plausible thought to end on. Thank you so much for joining us on this deep dive. We hope it gave you a completely new lens to view global events through, and we warmly invite you back for our next exploration. Stay curious.